Good morning. Today we have with us Sri R. Srikanth, Assistant Director, NAS in Chennai. Good morning, sir.
Good morning, madam.
We are going to unpack some of the finer, often missed out points in GST law. Shall we start with the most important sections like 73, 74 and 74A of the CGST Act, sir?
Sure. The first thing that people get wrong is the starting point for counting the time limit. Under section 73, the order has to be issued within 3 years from the date of furnishing the annual return, not from the date on which the annual return was actually filed. That distinction matters a lot for making the demand within the time limit.
So, even if someone files their annual return late, the clock starts ticking from the due date.
Exactly.
And section 74?
Under section 74, the order must be passed within 5 years from the due date of furnishing the annual return. Again, the due date of filing matters most and not the actual filing date.
Now, what about section 74A? That is the newer provision, isn't it?
Yes, 74A applies from the financial year 2024-25 onward. Here, the notice must be issued within 42 months from the due date of furnishing the annual return. Once the notice is issued, the department then has 12 months to pass the order.
That's a reasonable window for the order. Now, once a show cause notice is issued, how much time does the taxpayer get to pay the dues before the order in original is passed?
This is where it gets interesting. The payment timeline have changed too. Under section 73 and 74, a taxpayer has 30 days from the date of issue of the show cause notice to pay tax and interest or tax, interest and penalty in fraud cases. But under section 74A, that window has been extended to 60 days.
And after an order is passed?
Same pattern. Under section 74, you get 30 days from communication of the order to pay with reduced penalty. Under 74A, that is now 60 days.
So, essentially, 74A is more taxpayer friendly on timelines for those who opt to pay before the issuance of the order, isn't it?
Precisely. They get more breathing room to respond and pay.
Let's move to Rule 7 of the CGST rules. This is about how the amount of tax under the composition levy is computed, correct?
Yes. Rule 7 prescribes that tax is determined either as a percentage of the turnover in the state or union territory or as a percentage of the turnover of taxable supplies, depending on the case. And here is the final point. People often assume these two terms mean the same thing. They don't.
How do they differ?
Turnover in the state is defined under class 112 of section 2, while turnover of the taxable supplies is defined separately under class 108 of section 2. They are distinct definitions with different scopes, so using them interchangeably can lead to incorrect tax computation.
Now, section 108, that is about revisional authority, isn't it?
That's right. The revisional authority has explicit power to stay an order passed by the adjudicating authority. However, the first appellate authority or the tribunal do not have any explicit power to stay an order.
So, what happens if someone appeals and wants relief from recovery in the meantime?
The recovery proceedings are deemed to be stayed once the taxpayer pays the admitted liability plus the required pre-deposit amount. There is no separate stay order needed. The stay is automatic upon that payment.
Let's talk about section 107, the first appeal.
The key point here is limitation on power. The first appellate authority, whether it is the joint commissioner or additional commissioner or commissioner appeals, has no power to remand, meaning they cannot send the case back to the original adjudicating authority for fresh consideration.
Now, section 112, that is appeals to the appellate tribunal, has an asymmetry between taxpayers and the department, doesn't it?
It does, and it is a subtle but important one. A person other than the department has 3 months from the date the order is communicated to file an appeal before the tribunal. But the department has 6 months from the date the order was passed, not communicated, to apply to the tribunal.
So, the department's clock can actually start running before they have even formally received the order?
Yes, and there is another nuance worth remembering. A private party files an appeal, but the department technically applies to the first appellate authority and the tribunal. It is not called an appeal when the department does it. It is called an application.
Does the difference in terminology between application and appeal change anything substantially?
Not really. The law clarifies that the department's application is treated as if it were an appeal against the order for all practical purposes.
Got it, sir. And anything about section 121, sir?
Section 121 simply lists out the non-appealable decisions and orders. Some of the orders or decision cannot be appealed against. For example, an order for transfer of proceedings from one officer to another officer, or an order pertaining to the seizure or retention of documents, or an order sanctioning prosecution under CGST Act, or an order passed for payment of tax and other amounts in installments.
Are there any interesting points in refunds?
Yes, refunds are one of those areas where people only remember the common categories such as refund on zero-rated supplies or deemed exports, unutilized ITC on account of zero-rated supplies, inverted duty structure, balance in the electronic cash ledger, excess tax paid or any other amount paid, arising from an appellate order or court order, and to UN agencies, consulates or embassies.
Is there anything left out?
Yes, there are two more types of refund. First, refund of tax paid on inward supplies of goods received by the canteen stores department. Second, refund of integrated tax paid on the supply of goods to a tourist leaving India. The second one has not yet been brought into effect.
Any nuances regarding interest on delayed refunds?
There are two rates of interest to remember, 6% and 9%, depending on the nature of the refund claim. 9% for delayed sanction of refund arising from order passed by an adjudicating authority or appellate tribunal or court which has attained finality. 6% for other types of refund claim.
Now, coming to refund of pre-deposit. If someone pays a pre-deposit to file an appeal and the appellate authority or tribunal later rules in their favor, how interest has to be computed?
When the pre-deposit amount becomes refundable as a consequence of an order from the appellate authority or appellate tribunal, interest has to be paid from the date the amount was originally paid till the date it is refunded.
So, it's not calculated the way a normal refunds interest is calculated?
Yes, and that is the key distinction. For a regular refund, interest typically kicks in only after 60 days from the date of the refund application, if the refund hasn't been sanctioned by then. But for a pre-deposit refund, the 60-day cushion doesn't apply. Interest runs from the actual date of payment itself, not from 60 days after the refund application.
That's a meaningful difference for taxpayers who have had funds locked up during litigation. Now let's shift to the e-way bill provisions, specifically Rule 138(1) of the CGST rules. How is consignment value of goods defined for this purpose?
The consignment value is essentially the value determined under Section 15 of the CGST Act. So the standard transaction value rules apply, but it also includes the central tax, state or UT tax, integrated tax and cess charged on the document, if any.
So, unlike some other computations, this one is inclusive of taxes, sir?
Exactly. All applicable taxes and cess shown on the document get added into the consignment value. However, there is an important carve-out.
What's excluded from that?
Where a single invoice covers both the exempt and taxable supply of goods, the value of exempt supply is excluded while arriving at the consignment value for e-way bill purposes.
So, if a taxpayer issues an invoice with a mix of exempt and taxable goods, then they need to count the taxable portion plus applicable taxes only?
Missing this exclusion is a common error. Taxpayers sometimes include the full invoice value, including exempt goods, and end up generating e-way bills where it is not necessary.
Sir, this has been a fantastic rundown of some of the finer points in GST law. Thank you for breaking these down so clearly.
It's my pleasure. These details are likely to be missed out when officers are actually working in the field.
Thank you, sir, for discussing about the finer points in GST law that generally people might miss out.
Thank you, madam.
Thanks for watching. That's it for today's session, and we'll meet in the next video.